presentation. So let's talk about Alamo Mortgage Holdings and how Alamo Mortgage Holdings can help you to obtain more passive income. Our company is a United Kingdom company, and we provide passive income to non-US accredited investors. And our company focuses on mortgage note investing. So we don't buy real estate directly, we purchase mortgage debt. And we purchase mortgage debt in the United States, and we purchase mortgage debt in the state of Texas. So we're not purchasing mortgages all over the United States. We have a team that's from Texas, and that is our area of expertise. That's our area of focus. We focus on purchasing at a discount to the face value, and that allows us to pay our investors very high rates of passive income, far higher, hundreds of basis points more than they can earn with UK gilts or premium bonds. As an example, we might purchase a private mortgage note that is secured by real estate that has, let's say, an unpaid balance of $100,000 US. And let's say that that note pays a 10% rate of interest. We would negotiate with the owner of that note, and we would say, hey, if you want to sell that note, Alamo Mortgage Holdings can buy that note, and we will pay you $70,000 cash for that note. So that's a $30,000 discount that we're trying to get in this example. After we purchase that note, we find a motivated seller. After we purchase that note, the borrower now makes payments to Alamo Mortgage Holdings, and our yield on that hypothetical note that pays 10%, that has a 10% interest rate, because we purchased the note at such a steep discount, the yield on the note is now 14.2%, and that allows us to pay our investors 8% passive returns. You know, folks, the current low interest rate environment, it simply does not provide many options for an investor to earn passive income while having the all-important safety of capital preservation. Alamo, we solve this problem for our investors by focusing on the state of Texas. We have a focused niche market, and we're able to deliver great results to our investors. So now let's give a real example here so that you can get kind of a better idea of what we are doing. This is a real property. This particular property, it's not one that's in our portfolio, but I show it as an example to explain what we're doing. This property has a price, it is for sale, of $120,000. It's about 100,000 pounds. And let's say that the property sold for 120,000. Now, normally what would happen would be a buyer would go in and they would go to a bank, and then they would get a mortgage and buy this property. But there's a section of the market that is not using bank financing because they may not qualify for bank financing. So in this example, let's say that the buyer went to the seller and said, I'll pay you $120,000 for this property. And the seller said, great, pay me $120,000. And then the buyer says, well, I went to the bank, and because I'm self-employed, the bank won't give me a loan. They said I don't have a long enough history, but I've got $20,000 in cash. How about if I pay you $20,000 in cash, and then you let me make payments to you on the other $100,000? And then the seller said, well, you know, I really wanted to get all of the money on the day I sold the property, but if we do it legally, where if you don't pay me, I can take the property back, I might be willing to consider that, but I would need a high interest rate. I'm not going to finance this at a low interest rate. And they negotiated, and they arrived at a figure of 10% interest. It could be higher, it could be lower. It's just a negotiation between a buyer and a seller that took place. So with this example, they signed a note, the buyer paid the seller $20,000, It closed at a title company. It closed properly at a title company. The legal paperwork was done properly by a title company attorney. And they agreed to 360 months, 30 years of payments of $877.57 per month. Let's imagine that 5 years have passed, so that for 5 years, the buyer has been making payments of $877.57 to the seller. And after that 5-year period, the seller goes through a situation where the seller needs cash. It could be any reason the seller needs cash, but for whatever reason, the seller wants cash. Now the seller has a situation where he can't easily convert that note to cash because there's not a lot of companies out there that buy these types of notes. There's some, but he is in a situation where he wants to sell that note. He would potentially respond to Alamo Mortgage Holdings. We would make an offer. So the present value of that note would be the unpaid principal balance. And as we know on mortgage amortization at the beginning of a loan, the majority of the payment is going to interest, not to principal. So the unpaid balance on that note is $96,574.32. But for Alamo Mortgage Holdings, that's not going to be enough of a discount. We're going to negotiate, and let's say that we want to earn a 12% rate of return. The most that we could offer to that seller would be $83,322. Now, we might only offer $60,000. We might only offer $70,000. It's a negotiation, but we could go up as high as $83,322 and purchase that note. Now, if the seller agrees to that, we have instant equity in that note. And what that means is the debt compared to the value of the asset, there is $36,677.61 of equity in the property. Now, let's talk about how this is so important for investors that are from the United Kingdom, because I know that in the United Kingdom, there's a lot of financial products that they offer passive income. Heck, some of them even offer a good amount of passive income. But there's something that I want you to think about, and that is something that is the effect of the British pound exchange rate, what that does to those returns. So we have here a very interesting graphic. This is a record of the exchange rate over the decades since Bretton Woods, since the Bretton Woods Agreement in 1945, when 1 British pound would purchase $4 US. And then if you went to 1967, 1 British pound would only purchase $2.40 US. And then if you went all the way to, say, 2010, 1 British pound would only purchase $1.60 US. And we find ourselves in this situation today where they're almost at parity. 1 British pound will only purchase $1.21 US. So that is a real issue if you have all of your wealth in British pounds. It's something that you may want to think about, because if the pound is to continue that trend as has been going on for decades, that could have a real impact on your rates of returns. One of the nice things about our financial product, about what we offer for our investors, is the fact that we give you a choice. If you're comfortable with British pounds and you want to stay in British pounds, we support that. We can we can pay you in pounds. If, on the other hand, you are of the opinion that I want to diversify some, I want to get out of this British pound, some of my holdings, and get into the US dollar, we can do that. We can sell you the product where it's paid in dollars, because on the day you purchase, say you put in 100,000 pounds, we can do a conversion. We don't make any money on that conversion. We give you the listed exchange rate. We're not trying to make money on an exchange rate. But whatever is agreed to on that day, we're going to follow through on that for you. So if you want to be in dollars, we can pay you in dollars. If you want to be in pounds, we can pay you in pounds, or what some people may find interesting is to do a split where you put half of it in pounds and the other half of it in dollars. And that allows you a way to essentially hedge no matter what happens. So it's definitely something to consider.